So we're roughly a week away from the Federal Reserve meeting, and they're probably going to raise rates for the first time in almost a decade. One thing that people are a little bit concerned about is that a lot of traders out on Wall Street have never actually experienced an interest rate increase. But with us today, we have somebody who's experienced more than a couple of rate increases. In fact, we have Dan Fuss, who's the vice chairman of Loomis Sayles, and you've in fact had a bond bear market, which not a lot of people can remember.
Right. Well, the good thing about the bond bear market is it is an interest rate bull market. My first 23 plus years in the market, interest rates in general were rising. It was a wonderful time to be a bond manager. People laugh when I say that, but as soon as you think about any time you're reinvesting, that's how the life insurance companies became growth stocks.
Yeah, you're always investing at a high interest rate.
Right.
But are we going to have the same thing now? I mean, what's going to be the impact? I'm assuming that the Fed is going to move next week, and that looks pretty certain. Is this going to be a good bond environment, or are people going to react a little bit nervously?
Well, I think that, number one, I don't know. My guess is that they'll go to a quarter. Now, Fed funds rate, it has been creeping up. It's in the mid-teens now. The new issue of the 90-day T-bill, 8, 9, 10, 11, 12 basis points. 6, 7 weeks ago, it was at 0. So the markets are adjusting at the short end of the market. Not so as you go out to intermediate and long.
How many interest rate increases do you think, or quarter point increases, do you think we could see next year?
I don't know. I don't expect it. There might be one in January. After that, I would not expect any until December.
Oh, really?
Because of the election. Now, famous last words, right? But I think the Fed is caught. The Fed's caught between one rock and at least 4 hard places. It is the economy, okay. It is inflation as presented through various averages, okay. And then you get to the actual and the feared reaction overseas.
So we've seen some turbulence in the credit markets recently. Lots of corporate bonds have had a bit of a hard time, especially in the high yield or junk market. How worried should we be about this, especially since the Federal Reserve is planning to raise interest rates soon?
Well, I think in reference to the credit cycle, we're past the midpoint. We're in the 3rd quadrant, roughly, just looking backwards. The problem with there is no such thing as a perfectly standard credit cycle. We and others will display it on a circle, and we'll have the 4 segments of the credit cycle. It makes more sense to show 8 or 16 or 32, but it starts to boggle the mind of the analyst. And no credit cycle is ever the same.
As I open with, there's quite a lot of people that haven't experienced an interest rate increase before. Is that something that worries you, that this will actually be a novel move by the Fed for a lot of people in the market today?
No, it doesn't worry me. I know there are younger people out there. My wife and I are partially responsible for that. So I'm aware of that. But, and in his case, he is in the financial area. He's heard my discussions over the dinner table when he was younger. What they have not experienced is one after another, after another, after another, after another, after another cycle with each level of rates being higher.
Well, Dan, thank you so much for being here today.
You're welcome. You're welcome. Thank you.